BlackRock and Coinbase recently decided to join forces and create a bridge for institutional money flow to go into crypto. Naturally, the general crypto community loved this because they finally got the validation that they were looking for, that this will generally rise the tide of Bitcoin and crypto because of the new influx of money. At this moment, I won't say it's positive or negative because, well, go look at Twitter. It's not too difficult to trip over someone chest beating positives. It's a lot more difficult to find the negatives. And in my opinion, you have to be aware of both the risks as well as the rewards because they shift. Just like not subscribing to this channel runs you the risk of being blindsided when something bad does happen. My first concern is that there are a lot of idiotic institutional investors out there as well who will make mistakes, tank funds, and create new funds only to wash their hands of previous failures and stuff. Remember, at the end of the day, they are still professionals, but it's still your money that they're essentially gambling with. And to give you an example, think back to about 2021. Bill Huang of Archegos Capital. He was viewed as someone with the Midas touch, and although his firm was only a family office with $10 billion under management of his family, friends, as well as his own wealth, other institutions salivated to loan him some extra capital so that he went from $10 billion up to $30 billion. Now, the general consensus was that he was a relatively safe player moving in only blue chips, but the assets he invested in started to go against him, and he eventually was forced to liquidate, which hammered the stocks and, well, I'll just let you see on screen the damage that one domino caused falling. This leads me to my second point about dominoes. So, for example, in the crypto space, you recently saw this year. It's called contagion risk, with what happened with Three Arrows Capital went down. Celsius Network, Terraform Labs, otherwise known as Terra Luna, and Voyager Digital. I've always been quietly told by these crypto experts that these are three separate companies, that they have essentially no ties to each other, and that certainly that they would have no effect on the underlying price of Bitcoin if they all failed. I don't know, the price kind of tells a different story. I had to lay a lot of groundwork out, so please just bear with me. Funds, when they manage your portfolio, they have to maintain a certain percentage for everything, and typically the way it's divvied up is that it's 60% bonds, 40% equities. If your bond portfolio gains 2% but your stocks are flat, now it becomes misweighted, it becomes 62-38. In order to rebalance it, they have to sell that 2% gain you got in bonds and to buy back the equities to rebalance it to 60-40. This is typically the part where most people get their positive feelings and think that because they made a 2% gain, they're reallocating profit to other things that could potentially yield some sort of return. But they're also not considering the other end of the story that could also happen, which is if their portfolio actually went down. Now, in this case, if you lost 2% in your bonds, it becomes 58-42. In order to rebalance that, they have to sell 2% of your stock portfolio and put it back into your bonds. And in no way, at any point in this indication, did I ever say that those stocks have to be in profit or in the money or whatever. They could actually just rebalance it when it's already at a loss. Now, with that groundwork in place, let's imagine a 60, 35, and 5 split. So 60 bonds, 35 stock, 5 crypto. For simplicity's sake, let's just say the crypto portfolio consists of just Bitcoin. Take everything I just said in consideration with history and how the funds are managed. If we had like the 60 bonds, 35 stock, 5% crypto, let's say Archegos goes down. Your stocks are affected. Okay, well, you sell your bonds, you sell your crypto to rebalance that or whatever, right? And then what happens with crypto, you have Celsius going down, you have Terra going down, you have Voyager going down, all of them at different time intervals or whatever, right? All of them going down. So you have to rebalance with your stock portfolio, with tech kind of diving, and your bond portfolio as well. It quite literally just becomes a rebalancing act. Okay, well, we got to rebalance this to kind of even it out. Okay, well, this falls now, so now we got to rebalance it here. It just keeps going like that, and your entire portfolio just keeps getting chipped away one by one by one. One saving grace, though, that everybody has is that they have to know when their funds rebalance. Sometimes it's monthly, sometimes it's quarterly, so they rebalance quite slow. I'll leave it up to you to determine whether the speed is a benefit or a detriment. Sometimes you miss out on good opportunities, sometimes you avoid the bad ones. But when your portfolio starts going up, it might not have the equal, return upswing that you thought you would have because, again, rebalancing has to take place. If one side is, overperforming, they have to sell that and then reallocate it to the other ones. This is all said without considering fees as well on top of this, because the more they have to rebalance, the more fees they pay, the less return you get. These are some of the surface thoughts I had in my head when I immediately read this, actually a day after I read this, but to reiterate my points, I think people need to ask more questions, not just drumbeat the positives, because, sometimes the risk can outweigh the rewards. But, you do what you want to do. And just remember, just because you're a day trader doesn't mean you have to trade every single day.